My screen now? Yep. Okay. All right. Right, so let's look at what's going on in the S&P. Make sure I got everything. Yeah, okay. Okay, so right, so it looks like last week we were in a position where we were super oversold, and the oscillator that Jim Cramer was talking about, the S&P oscillator, was pretty much at its lowest point in a really long time, and Jim Cramer said you got to basically hold your nose and buy something. That's what he was taught at Goldman Sachs. So whenever things are oversold and things are going down and downward trend, you have to buy a little bit at a time if you're not invested yet. And dollar costing prevents you from jumping out if it gets too bad. And we're following our strategy here. We knew we had an idea that Labor Day, holidays usually have better results. But when we came back on Tuesday, that was a down day, surprisingly. But the rest of the week was good, so that we're actually up 3 or 4% since this time last week. So we're basically in a process of going from an oversold state, hopefully, to an overbought state. We have some catalysts coming up in our next 2 weeks, which is the Fed meets on the 20th. They might, if they say some kind of definitive, this is it, we're done raising rates, 1 point and done, or whatever it is, that's a good indication that the stock market likes that. And if they say we're going to raise much more later, then the stock market will go down. It's just like a binary thing. But we have end of quarter window dressing to look forward to. That's whenever the best performers of the year to date get piled on by the hedge funds trying to look good for their constituents. Then October, we're going to have an overbought situation. Right now, we're still oversold, starting to go up. We'll have an overbought situation soon, in the middle of October maybe, and that's why we're thinking it's going to be, down, and people get scared in October too. So just to be ready for that. And we always have a good end of the year rally. So by this time, we should have some kind of better indication of how inflation is going because inflation has a lot to do with the uncertainty in the stock market. Also, the dollar right now, the dollar is causing a lot of estimates to go down across the board for the United States stock market. And the good thing about that is that the estimates are going down, but the dollar is not going to go up forever, and it'll go down, and that will be a tailwind for stocks. So that'll make stocks earnings better. So that's why it's important to focus on good stocks and buying and accumulating them over time and holding them. Right now, it's just a negative part of the calculation for stocks to go down, the strong dollar. So we'll keep our eye on the dollar and how maybe it might get stronger if the Fed raises rates more, that makes the dollar stronger. So it looks like we might be done raising rates maybe this month or next month. So these all have okay. So let's go to that's the big picture. S&P is up 3% since last week. Seems like we're having a currency war. This is a variable that we haven't really been talking about yet, but a lot of the foreign currencies are the ECB raised interest rates. China and Russia are kind of colluding to make maybe a dominant world currency. I don't know. They're actually doing business with each other more, and they're bypassing the dollar. They're buying and selling things in China, yuan, So if the United States loses its reserve currency status, that's really bad for the United States. It probably won't happen, but that's like one of these major risks that might happen. So we'll keep our eyes on that kind of thing. But right now the dollar is strong. The Fed never fights market rates. So the 10-year, as the 10-year goes up, the interest rates will go up too. So as an example, we look at the 10-year. Last week it was 3.6. This year it's 3. Last week it was 3.6. This week it's the same. So it's unchanged. So if, for example, the 10-year U.S. Treasury went up to 4.2, the Fed will be forced to raise another point. And I think I'm just learning about this. I'm not sure about it at all, but it seems like as these rates go up, the Fed has to raise rates because it keeps up with these rates. All right. So right now it shows that the Fed probably isn't going to raise rates more than a point. So that's good for the stock market. Right now the rates are going up. That is traditionally good for banks. And there are people like Doug Cass that are saying that the banks will be beneficiaries of rising interest rates, and people are not taking that into account. And he says banks are going to be one of the best performing assets in the next year. So that's a really interesting viewpoint. That no one's thinking that now but him. So we'll keep an eye on that. But if the interest rates keep going up, that is definitely better for banks, even though they're not performing well now. Okay, so let's look at other things. We always look at the catalysts for markets to go up. We keep track of the catalysts for markets to go down. We don't know what's going to happen, but next week on the 20th, that's a week and a half from now, we're going to find out about the statement that they make when they raise rates on the 20th. Good earnings announcements. P&G reaffirmed guidance, so that's very, very. They're a bellwether for the consumer product. That means that they have pricing power. A little bit later on, I'm going to explain some of the sectors that have pricing power, like food, energy, and consumer goods. So that's, and they also mentioned that the P&G also mentioned that the commodity prices are going down, and the supply of resources, the commodity bottlenecks are getting better. So we just have to listen to these reports and just check off, reasons for the market to go up. And let me see. So right now, what else? Inflation is getting better, yeah, because commodity prices continue to go down and gas prices are going down. And we have an oversold market. So all these, and you combine them, that is a good indication that we're going to, we have a positive momentum in the stock market. Other things, corporate buybacks. I've added this as a check mark because the new law we mentioned last week, the buybacks are taxed at 1% starting January 1st. So we were guessing last week that a bunch of companies will start buying back their stock before the January 1st deadline. And that could give us, some kind of momentum. And, if companies are buying their own stock back, that'll push up the price of that stock. And it'll give us momentum going towards the end of the year. So we had a note this week that T-Mobile is going to start buying back stock. T-Mobile is trouncing AT&T and Verizon now, and they're actually, another indication that they're doing really good is they're announcing this buyback. So we added that to our watch list last week as a stock that's probably growing around 30%. And we're waiting for for it to go back down to its fair value. It's really overvalued now, but it's best telecom. Okay, so what else? All right, so I'm going to go over a little bit later. Companies doing great in this environment, the ones that have pricing power. And we've been saying companies that can raise prices in an inflationary environment, and companies that have profits and do well in a rising interest rate environment. Okay, so we're going to go over some of those later on. And right now it seems like we have some complicity in the stock market. We have oil going down 3%, 3.5% since last week. So the gas prices we see outside are going down. That's good for the consumer, and that feeds into the stock market. And let me see. There was a cut by OPEC. That should normally, if they reduce the supply, that should increase the price, but it didn't for some reason. So maybe economic activity could make the price of oil go down because the more demand, well, the less, if the economic activity isn't that great, then the demand isn't great, so that will make the price go down. Maybe that's what it was. 10-year Treasury is flat, unchanged since last week, and that's really good. There's an indication if it starts going down, that's really good for the stock market. And inflation, we're just waiting for we're waiting for these to be filled in and to see if it continues going down. If it does, then there's a very good indication that we'll be back to this 2%, which is a target for the Fed in maybe 6 to 12 months. And let me see. All right, so let's look at the sectors, see what's doing good today. And let's look at the commodity prices, because that's really important. Okay, let's go down and look at the price of oil. It's up 4% today. Okay, that's news. So the price of oil is up, and we guess now that the sector doing the best is oil. Energy, yes, at the top. Oil, service, gold miners, metals. Okay, so materials and oil is doing the best today. Energy. Okay. The ones doing the worst, which aren't that bad, are these are the conservative ones. So today we have sort of like a risk on where people are not as excited about buying utilities, healthcare, consumer staples, which have done really good this year, and they're moving towards some of the, of course, oil has gone up, and some of the technology stocks are going up a lot too. So it's pretty much going to risk-on situation now. And people are moving from this fearful environment to a little more confident. All right, so let's look at some of the market movers in the S&P, ones that are going up the most. I'm not sure why Kroger is up. That was a very conservative stock that pays a dividend and would do good in inflationary environment. But let me see. These are stocks that were sold off a lot, and they're now just ramping up because, like for instance, Match Group. Some of these are oil stocks, but Royal Caribbean, these are stocks that are basically sold off, like they're going to go bankrupt, and now they're just Carnival Cruise Line. These are all stocks that people left for dead, and they're now starting to be bought as if there's nothing wrong in the stock market. The one's going down the most. Okay, health stocks. We know a lot of our stocks we're following in our stochastics are in a downward trend. They were some of the best performing stocks. Let's look at the healthcare. Okay, it's most of the individual stocks we're following, like Abbott Laboratories. They're pretty much in a downtrend, and this is becoming an out-of-favor sector. And you can see, I guess, that a lot of these healthcare stocks are going down. But the healthcare stocks have a consistent demand in good times and bad. So you'd figure that it would do good in a more conservative when people are fearful. And I guess right now what's happening is those are being thrown away for risk-on trades that have more risk. All right, so let's look at some of the NASDAQ stocks that are going up the most. Zscaler, 20%. Wow, Mark, why is it up 20%? No answer from Mark. Okay, well, it's up 20%, and then as one stock, this is a cybersecurity stock. So I guess all the cybersecurity stocks will go up with it. I don't see them in this top 10, but we see some gravel stocks. Okay, so we have Booking Holdings.
They had a good earning, that's why I guess.
Good earnings. Okay.
Yeah, that's why they went up.
Okay, that makes sense. So now all the related stocks, like CrowdStrike is a cybersecurity stock, they go up in sympathy. And it works the same way on the downside. Whenever stocks are going down, if Zscaler had a bad report, then all the related stocks like CrowdStrike would go down with it. But there's a consistent demand right now for the cybersecurity protection, and a lot of these companies like Palo Alto and Zscaler, and we use Zscaler here, and CrowdStrike, they're really overpriced, but they're growing a lot too. So it's hard, that's kind of out of scope for what we're doing here. I have these ways. Let's go through one of these, like Zscaler. This is an example of a stock that I've looked at before, and it didn't have all the pieces we like to look at. Let me see, it's probably growing. Zscaler, rats, whatever. ZS. Okay, Zscaler. Let's look at the statistics on Zscaler. And let's look at
So Zscaler had been underperforming the NASDAQ for a little while here, but it looks like, it's gone back up, and it's not like it. I think it's just getting back some of the losses over the last month.
Oh, okay. So there's a lot of dead cat bounces. Now, you can call them dead cat bounces, but there's a lot of stocks that went down like a lot, like this one right here. It went down, and it bounced up. A lot of times stocks like that retrace halfway, and, as maybe at the most, if they're a bad stock and they bounce, they would bounce halfway. If they get beyond halfway, that's great. But a lot of times they go back down. But let's look at, so it's an example of a stock let's look at their earnings.
I wonder if the estimates, because it had dropped down below the NASDAQ average, and now it's way back up above it. But I wonder if there was, the thought that was the earnings wasn't going to be good, and they're better than expected. So it really got that big boost.
My guess is that there's a lot of red I didn't see this yet, but there's a lot of red in this earnings projections for this stock. Let's look at a lot of these, they're high growth. They grow but they're not profitable. Let's see. Earnings. We want a straight line up if we're interested in this. That's really good. No. 22. Okay, that's messed up. The first two we can ignore, but it's growing at earnings like, was it 40%? Let's look. I'm dividing 22.665 divided by 1. That's 43%, 35%. Wait, 42%. And 1.13 divided by 1.59, 29%. That's around 35% growth. Now, let's look at their numbers. Okay, that's fine. 35% growth. Its PE is, look at that. It's not growing at 136%. So let's say 136 divided by, it's growing at 35%. That's 4 times overvalued. PEG ratio Yahoo says is 2.73. Okay, so well, maybe our numbers are. Yahoo is using that 45%. So 136 divided by 45 is 3. Okay, so Yahoo thinks it's growing at 45%, and that's where it gets this. So it's 3 times overvalued, but is it consistent? The problem with this stock is that a lot of these numbers that we like to look at for efficiency of a company, they're not there yet. And for me, I don't know. I just have these rules, and if I don't understand when there's negative numbers, and they're definitely growing their earnings, at 35%. Why these numbers come up negative, I don't know. And you see this a lot with growth companies that are just in a process of spending, they're acquiring, they're earning a lot, but their expenses are making negative numbers. So all that being said, let's look at another one so we can see that it's growing at 35%. Its PE ratio is 4 times that. So that's why I wouldn't look at this. Or if you invest in this, you'd have to. Let's look at the short ratio. Percentage of shares short. Look at that. 8% short. That's basically a short covering rally today. That means if there's these companies, the people out there were betting, 8% of the float was betting that it would have a bad earnings report. And as soon as it had something decent, a lot of them covered their positions, their short positions, and that caused a big spike of 20%. And that doesn't mean it's a good stock. It doesn't mean that in 10 years it's going to be higher than it is today. We don't, there's a lot of negative numbers here, but it's most likely because of that short. That's a big percentage of the float that's short, actually. So that's a good exercise we did there. And, oh my, DocuSign again. DocuSign is one of those stocks that are super highly priced, and it's down to 63 now. CrowdStrike. Let's look at the other cybersecurity stock, CRWD. Let's do that same exercise, CRWD. My guess is it has a similar negative numbers. Earnings per share, negative 0.79 cents per share. Okay, we have almost the same situation. We have negative numbers, and PEG ratio is 4 times overvalued. So if we're guessing now it's growing at 30%. So if we look at CRWD, let's see what it's growing at. So a little bit later, I'm going to describe the importance of durable earnings and consistent earnings. This company, let's look at this. Okay, you see, a lot of times, this is great. It's going in the earnings are going up in a straight line, which is really good. We're guessing 30% based on 1.33 divided by 1.87. 30%, 1.87 divided by 2.72. 30%. Okay, so it's growing at 30%, but its PE ratio is 144. So 144 divided by 30%, 4.8. So we think it's 4.8 times overvalued, and it's missing a lot of numbers here. All right, so let's look at the debt. Total debt is 800 million, and their market cap is, okay, so it's a very small amount of debt. You get worried whenever it's closer to the amount of their total market cap, but it's manageable. All right, so this is an example of a stock that's more of a growth stock, and you really can't put a whole lot of money into stocks like this because they're well, the way I do things is I have a certain portion of my portfolio with compounding stocks, and that's kind of what my specialty is. And I'll go over those later on. But compounding stocks are ones that reliably return a certain amount over time, and they have good return on equity and good fundamentals, and they have a lot of cash. And this is an example of a stock that, in a bad time, would crater. If you had a time when the stock market's selling off, stocks like this with high peg ratios will not hold up as well. So let's look at the chart on this. It probably is the same as the other Z-scaler. Yeah, it's a very similar chart to Z-scaler. All these subsecurities went down, and it bottomed out right around the end of May. So, it's going. Yeah, it's like a little up pattern here, like the S&P. All right. Let's go back and look at some of our notes for today's meeting. All right. Okay, let's look at the S&P. We were noticing last week, that we're in this little downtrend here. And as of this morning, we basically were at the top of this downtrend. And I mentioned last week that we had the support right here, which was a level we hit, back in June. Is it June or May? So a lot of times, whenever you look at where the stock market's going to have support, you look at the past levels where it bounced off of, and it basically maintained. The next level down will be at this level here, because you see on June 17th we hit a spot and we bounced from that. But we are actually starting this. You can call it like a little uptrend, and we're at 100-day moving average in the S&P, and we have a lot of positive catalysts, and the end of the Fed's talking on the 20th. So, but we are at a critical spot here in this new channel we have here. We're at the top of this downward trending thing, but we're just using this to time our new purchases, not to time the market. Peter Lynch said it's time in the market, not timing the market. So we have to remember that. All right, so let's go to the next little thing we're looking at. Okay, so the next thing is the yield. We already talked about it. The 10-year is unchanged, and that's really good. We want it to stay as low as possible for the stock market to go up. And fear and greed, we're getting a little bit more and more greedy as time goes on. And next week will probably be neutral. Maybe, I know towards December and the end of the year, we're going to be in the greed. Right, so the VIX, it's actually down 12% since last week. It's an inverse correlation pretty much to the S&P. So as the stock market goes up, the fear in the market goes down, and people don't buy as much protection, and they stop their. Well, that's basically confirming that it's good for the stock market. So if it gets down to 15 or 20 or 15, then we're back into a situation where we're going up. Okay, so we already mentioned stochastics. We're at 22. We hit like a bottom like last week, and we're starting to go up. So that's a good indication that we're going to have some good days ahead of us. And as people are still fearful, that fear of missing out will make people want to get into the stock market. And we're still in the worst month of the year, so we very well could go down to the bottom of this channel and continue this downward trend. We don't know. But for me, I'm holding all my positions, and I know that over time they're going to return around 10%, so that's all that matters to me. All right. There's an article, Jeremy Grantham, he's one of the smartest guys on the market. He predicted several asset bubbles in before, so he's already called out this as being a really big super bubble. But he runs a firm that actually still invests in stocks, and they reviewed his. And I researched some of his top holdings, and every quarter they come up with the top holdings of every fund. So his Grantham Mayo Van Otterlo fund, if you look it up it'll show you the top holdings. So I looked at some of the common things that we're following compared to what is in his top portfolio. And there's an article here that basically says why he was holding these things. He warned back in January that there is a super bubble. We saw the price of Bitcoin up, all these speculative instruments, a lot of things that didn't have earnings were going up, and he said this is a bubble. But even when he said that, he still invested in these stocks for his portfolio. And the things that they have in common, according to this article, are good balance sheet. So as interest rates go up, if you have a lot of cash on hand, you're not going to need to borrow money. So these companies are going to not be affected at all. Well, they'll be affected by supply of the products or demand for the products, but they won't need to borrow money. A lot of companies like Apple and Microsoft, when interest rates were zero or near zero, they borrowed a lot of money basically to grow their company at zero cost or 1% cost or less. So the amount of debt on some of these big companies' portfolios is just because they got free money, last year or the year before, and so they have enough money to expand, while every other company that has to refinance, like some of those travel companies, the Carnival Cruise Lines, they'll have problems trying to borrow more money at higher rates. Okay, so the other things they have in common, they have high cash flow. Their business, they have consistent businesses. We were talking about Anthem a couple weeks ago, how in good times and bad, people are still going to be going to the hospital. And the same thing with Eli Lilly. People are still going to be buying drugs from Merck and Eli Lilly because that's something that's not discretionary. It's something you need. And Johnson & Johnson. So, you see, stable businesses, max position of his portfolio. This is interesting. It's only 2.7%. And some of the other mutual funds and companies take much bigger position sizes. So he has 2,000 positions in his portfolio, and the other thing that's consistent with all these is whenever the economy turns and the Fed stops raising rates, they'll recover much quicker than the other companies. So, anyways, I did an overview of the top two holdings that he has for 5% and 3% Apple. We already reviewed United Health 3 weeks ago, so I wasn't going to do that again. Some of these stocks that he has in here, the U.S. Bank Corp, banks are a favorite. I think this is one of Warren Buffett's favorite stocks. Banks are a favorite of, in a rising interest rate environment, they should do better and outperform the market, theoretically. We haven't seen that yet. They're actually going down. But he sees the U.S. Bank Corp as maybe consistent business model. And you see Wells Fargo, same thing. It's a bank, and it will do better in a recessionary environment. We already follow all the ones in red, so I don't really have to go through those. But Coca-Cola, they had a problem during the pandemic where a good portion of their money of their products were sold in outdoor arenas and places that were closed, in bars. So they were down during the pandemic for that reason, but they have more of a stable business that people will consistently buy Coke regardless of price. And Pepsi was an example of our stock that we're following that was able to raise prices 10% without losing customers. This is a consulting company. I guess go ahead, I'm sorry.
I was going to say, for Coca-Cola, I actually just recently didn't buy Coke because it was more than 50% than another leading brand. The store was very, very much more expensive than the
Really?
Dr. Pepper products. Yeah.
Wow, no kidding.
It was 2 12-packs for $14, and the Dr. Pepper products were 3 12-packs for $11.
Wow, they must think that they have pricing power. I mean, we might learn very soon that they might have bad earnings because they raised the prices so much, but Pepsi got away with it.
Yeah, they said they're raising prices. I found some news stories saying they're raising prices, but they were a lot more than the Dr. Pepper products. So I don't know. We'll see.
Wow, let's look at the chart to see if they recovered from that pandemic. Okay, look at that. It went down to 37 during the pandemic. That's half of where they are now. So they recovered everything and more. Let's see. This is one of Warren Buffett's favorite stocks of all time. He has 5% of his portfolio in this. He just buys it and holds it, assumes that, over time that they'll be coming out with new products, and they're retiring products that are not as good and replacing them with ones that are better. And of course, they have a good marketing team. But look at that; it's a straight line up.
So they've said that they've raised prices and are still seeing strong demand. We'll see if that keeps going.
Yeah, let's look at their statistics. They have a dividend of almost 3%. That's twice the S&P 500. So that's really good. And I guess if you get to a point in your investing career and you want something stable over time, I don't know if they raised their dividend over time too, but that'd be a good. The reason why it's important to look for stocks with rising dividends, ones that increase every year, is that if you're retired, you have a inflation that goes up, or you have inflation and other things that make things more expensive. If you have dividends that are rising too, like maybe every 2 years or every year, a company that's in the dividend aristocrats grows their dividend a little bit. That just helps you, if you're buying and holding person. But it's really expensive right now. It's pretty expensive. Its PEG ratio is 3.47. A little bit later on, I'm going to go through some stocks that are. Let me see. Oh yeah, go ahead. I'm sorry.
Yeah, I wonder. I think it was 2 or 3 years ago we talked about people's concerns about kind of healthiness of sugar drinks, and I think there's even now some people being concerned about the health of artificial sweeteners. There's some evidence that it's bad for your microbiome and things like that. So I think there are some risks, but it's a very strong company. But there are some things that could go wrong.
One thing I don't understand about Coke and Pepsi is they still have caramel color as their main ingredient, and that's been proven to be bad for you. And they could use something that's a little more expensive, but they don't. That might come back to bite them someday. I don't know. A little bit later on, I'll go over this stocks, the sectors with pricing power. And one of the sectors that has the greatest pricing power is consumer staples. That's like Procter & Gamble. And let's see, if healthcare, energy, information, consumer discretionary. I thought food would be up there, but healthcare, energy. Okay, I thought food was there, but it isn't. Okay, let's go. We'll go back to that later on. But yeah, it's interesting that Coca-Cola is selling at a premium, a lot like Costco, because it has consistent earnings. Let's look at the earnings for Coca-Cola over time. The theory is that if you have a consistent earning stream over time, we expect like a downtrend 2002. Oh, it didn't do that bad during the pandemic. I mean, I expect like a big negative, gap in the earnings, but it's really not that bad. It's really consistent over time. When you look at a multi-year chart like this is 2021, 22, 23. You look at the quarters, like quarter 4, you compare that to quarter 4 the next year and the next year. So you can see that it's pretty consistent over time. In the second quarter is, it's going up. And then third quarter, the reason why you look at those is there's stocks like Apple that do really well in the fourth quarter because of Christmas. And they always have a fourth quarter that's higher than the other quarters. And you always have to compare the fourth quarter of one year to the fourth quarter of the next year. But this is an example of a stable company that you can see from the green that it's constantly beating their earnings or doing better than expected. And so that would demand a premium. Now, if we looked at another stock, let's look at a stock that's less consistent. Let's DocuSign. Let's see if its earnings. Okay, so we have. So it's not as stable. We have some, but they're barely scraping by, and then they did really good during the pandemic, and now they're going. It's kind of stable again. So people pay more when you have predictable earnings, and I'll go over that a little bit next. But it's always good to see this big chart, and we have that CFRA on Merrill Edge that tells us, in the past 10 years, how is their earnings and PE ratio, and you just compare that to what it is now. Okay, so what I did was I took the the top stocks in Jeremy Grantham's portfolio, and I looked at he added 6% to its Microsoft position in June. So he has a really good conviction on Microsoft. And security of cash is a theme. And he said for the healthcare, he said the rich balance sheet and consistent demand. And I took a look at Microsoft. We always look at this every now and then. Return on equity is 47%. And it's profitable. It's twice as expensive as what it's growing at, but it's consistent growth. Let's look at Microsoft just for fun, just as a comparison to like a DocuSign. I'm expecting like it to be growing consistently. So this is what he likes, Jeremy Grantham. He sees it's not much. It's like 10 or 12% a year, but look how predictable this straight line is. Even in the depth of the pandemic, it was still excelling. So that's why he has conviction, to buy and hold this. This is why I've held this since 2008. And I look at this chart all the time and I say, well, it's still going up in a straight line. All right, that's good. Check mark. And if it goes down during this time, I kind of ignore that. But the important thing that I'll explain later on is return on equity. That's how much return the company gets on the cash they have on hand. So another thing, they have a lot of cash. And I guess you net this out, it's $30 billion in cash. They just bought a company, so they don't have as much now. And the cash flow is operating cash flow, $90 billion. So these are things that these are reasons why he has conviction in Microsoft. Apple's the second holding. It's trading. We've been following this for a long time. We've been saying it's overvalued. Apple's only growing at 7%, but it has a return on equity of like 162. They have a profit margin of around 45. That's probably better than 95% of the companies out there, and it makes more money than any other company. Well, maybe not the oil company from Saudi Arabia, but but it's very profitable, and it checks all of our interested boxes. There's another article that's pretty much free that I found. It says it's from Morgan Stanley. They said the equity compounders, the value of compounding in an uncertain world. And, this is an example of a stock that goes over, what's important for the compounders part of your portfolio. Right now, about 90% of my portfolio is equity compounders. I just try to find high quality companies that are consistently making money, and they have dominant and durable businesses, and low capital intensity. So low capital means stocks like Google, they don't have to go out and service a power line every day like AT&T does. They have computers, and they have people that are programming the computers. That's the majority of their expenses. And so this article is saying companies with high return on invested capital perform over time compared to other stocks with lower return on invested capital. So that's why almost every stock that we're following in this our model portfolio has, return on equity, over 13%. That's our low level for what we're interested in. And the good stocks have higher return on equity. The difference between return on invested capital and return on equity is return on invested capital takes into account both debt and equity. So for our purposes, we'll look at ROE on that Yahoo Finance chart. And I looked at the Grantham's top 10 holdings and what the return on equity was for them. And they were all above our 13 number. Oracle and this other company, they didn't have numbers, so I just left them up. But a lot of times whenever you're getting ideas for your model portfolio, you look at people that are successful and that are billionaires and see what they're doing. And it looks like one of the stocks that let me see. Yeah, so I think that return on equity is a very important thing if you're a buy and hold investor. And remember the two stocks we looked at earlier today, the cybersecurity stocks, Zscaler and CrowdStrike, they both had negative return on equity. So they're basically still getting their metrics together where they can have numbers like this. So it's out of scope for me to understand those. Those are examples of high growth companies that don't fit this compounders equation yet. Any questions on that? All right. So in that same article, they mentioned the consumer staples sector as a sector that has pricing power. And these are different sectors that, and we mentioned way at the beginning of this year, the importance of companies that can raise prices in an inflationary environment are very important, and even for a long-term hold. And so we've been trying to look out for those, and here's an article that actually gives us some ideas for that. All right, so consumer staples, like Procter & Gamble, we found out this week, they reaffirmed their guidance, and they said that they have pricing power, basically. Healthcare, we saw in Jeremy Grantham's picks that they have pricing power, that if people are sick, they're going to the hospital, they don't care what it costs. And energy, they're basically at the mercy of the price of the underlying commodity. But you see, IT is an example of a place that has pricing power. Like Apple actually came out with their new products on Tuesday of this week. I didn't say that. Apple had we expected the stock market to be positive whenever there's a new announcement of technology, and Apple had a new iPhone 14. They had a new watch. So people are moving towards pessimism to more optimism now. And it looks like maybe towards the end of the year we might have this interest rate situation taken care of. So, but technology, let's see, let's look at what I was saying here. Rats, where was I? There it is right here. Okay, so technology, consumer discretionary, industrials, materials, and as you get down to financials, they don't have as much pricing power. They're at the mercy of they're at the mercy of the price price of the 10-year, I think, and the Fed rates. So utilities can pass on their higher costs. So these are also okay. So let's go to the next little section that I prepared. We already mentioned this. Procter & Gamble CFO restores forward guidance. So that gives us confidence if we're a long-term holder of Procter & Gamble that they can actually raise prices and meet their estimates. And this also gives us two hints towards our problems with commodities and inflation. They said commodity inputs are going down, and they said that transportation prices are going down, and they're trying to improve their efficiency with their network of input supply chains. So they're working on that, and so it's good to have that under control. And they said consumers are not trading down. That's a good indication for one of our stocks, Apple, we're following, because people might buy the new iPhone instead of trading down to an Android, perhaps. The other article that's really important to keep our eyes on is this massive rail strike. That'll, of course, affect all the railroads, Union Pacific, Berkshire Hathaway, and we have Norfolk Southern and CSX. So if that happens, then that'll affect the economy big time, because we already have a problem with commodity prices and bottlenecks, and this will make it much worse. So that affects the earnings of the railroads. It's good for trucking companies. It's bad for supply chains, and that could affect what people can get to their stores for Christmas. So all the retail stocks could take a hit because of this. So let's hope it doesn't happen. A lot of times the president goes in and tries to solve the problem, and because this is a really big problem. Hope it doesn't happen. All right, let's look at where we are in this emotional chart. Seems like a lot of we've actually gone. This is let's say June 17th of this year. Last week we were still in this depressed state. Now we're basically trying to come out of that. We're almost returning to the mean. We have a VIX that's going back to normal. We have people going from extreme fear to normal, and we're getting towards the end of the year when we have Thanksgiving and Christmas, and hopefully it goes up, but we don't know. For me, I'm investing even if it does drop 20% or 40%. If we look at the S&P, over time, let's look at the S&P. We could make a whole session of what to do whenever the stock market drops. Okay, if we had a situation like this, we can't predict it. We can't predict the next major drop in the stock market. But look what happened after it dropped. They've recovered within like 2 months. A lot of beginning investors, they would sell right here and then buy back, up here. And so your goal is to take advantage of situations in the market where the market gives you an opportunity and you don't take it. People sometimes are hesitant about opportunities, and whenever it's a bad time, and when it's a good time, they they do the opposite. So right now you have to be ready for it. Even if it drops 40% from here, you got to be still looking at the big picture and what are you doing with your investing? How long what's your time frame and what's your goals? And right now, that helped me. Thinking like that helped me through the pandemic and through this June 17th and doing this stochastics. This kind of helps us predict the market and the where the emotions are for each one of these sectors and where the momentum is. So you see any questions on any of that? We're almost at the end. Okay, you see. And the last thing is we're right in the middle, almost in the middle of September. It's traditionally a bad month, and we have the rest of the year with good returns to look forward to. If these are the same, but we can't really trust these. If I knew we returned 3% for the rest of the year, I'd be a zillionaire. But we just have to look at the law of averages over time. There are seasonal forces that cause these things to happen. But you just have to prepare yourself emotionally so you're not